stop. If you're still trading the 5-minute chart, this might be exactly why you're stuck. You take clean setups, you follow the rules, and yet the market keeps faking you out. Here's the uncomfortable truth: the lower the time frame, the more the market lies. But traders who quietly dominate, they're watching W1, D1, and H4, and it changes everything. In the next few minutes, you'll see why higher time frames consistently win, and the one mistake that keeps most traders trapped in noise. Ignore this, and you'll keep feeding the market liquidity. Most traders lose, not because they are foolish, but because they are impatient. If you recall the previous video on TOP, you already know the market does not reward speed the way beginners think it does. It rewards patience, position, and perspective. And nowhere is this more obvious than in the higher time frames. You see, the market has a way of humbling the man who stares too closely at it. Ever notice how the 5-minute chart looks full of opportunity, yet your account tells a different story? That is no accident. The smaller the time frame, the louder the noise. And noise, my friend, is expensive. I learned long ago that the big money was never made in the small swings. It was made in the big movements, the kind that take time to unfold. The weekly chart, the daily chart, the 4-hour chart. These are not just time frames. They are filters. They separate the professional from the excited amateur. Now ask yourself honestly, how often have you been shaken out of a perfectly good trade because you were watching every tiny tick? Most men cannot sit still long enough to let a trade work. They want action. They crave movement. But the market does not pay for excitement. It pays for being right and sitting tight. When you study the weekly chart, something interesting happens. The market begins to look calmer, clearer. The random spikes and false breaks begin to disappear. What you start to see instead is intention, structure, direction. And that is where the smart operator begins his work. The daily time frame refines the story. It shows you where the real battles between buyers and sellers are taking place. Not the petty skirmishes on the lower charts. The real fights where institutions position their money. Do you think the large operators are making decisions based on a 5-minute candle? Of course not. They are playing a longer game. And then comes the 4-hour chart, the bridge between patience and precision. This is where timing begins to sharpen. Not rushed, not forced, simply aligned. A good trader does not chase entries. He waits for them to come into his territory. Have you been trading or have you been chasing? You must understand something that most never grasp. The market is designed to exploit impatience. Every wiggle on the lower time frame is bait. Every fake breakout is an invitation to the undisciplined. The higher time frames, however, are far less interested in fooling you. They show the hand of the larger money more plainly, if you have the patience to look. This is not about taking fewer trades just for the sake of it. It is about taking better trades. There is a difference. Many traders measure success by activity. Professionals measure it by accuracy and position quality. Which one have you been doing? Your equity curve will often reflect your time frame choice more than your strategy. I have seen men with sound methods destroy themselves simply because they insisted on operating where the noise was thickest. They were not wrong in analysis. They were wrong in environment. And the market is very particular about environment. Remember how we discussed discipline in the previous video? TOP? This principle sits right on top of it. Higher time frame trading demands emotional control. It demands that you stop treating the market like a slot machine and start treating it like a business operation. There is also a matter of psychology, and this is where many accounts quietly bleed out. Lower time frames create urgency. Urgency creates mistakes. Mistakes create losses. It is a simple chain reaction. But when you operate from W1, D1, and H4, something shifts inside you. Your decisions slow down, your thinking clears up, you begin to act instead of react. Let me ask you something plainly. When was the last time the weekly trend completely reversed in a single hour? It rarely happens. But how many times has the 5-minute chart tricked you into believing a move was real? Too many to count, I suspect. Wealth in trading is not built on constant motion. It is built on selective aggression. The higher time frames help you become selective. They force you to wait for the market to reveal its hand. And patience, real patience, is a form of edge that cannot be easily copied. Another thing most traders overlook is risk clarity. On higher time frames, your stops and targets begin to make logical sense. Structure becomes visible. Levels hold more weight. You are no longer guessing where price might react. You are observing where it historically does. That is a very different game. But do not misunderstand me. Trading higher time frames is not easier. In many ways, it is harder. It requires sitting through boredom. It requires resisting the itch to interfere. It requires trusting your analysis when nothing seems to be happening. Can you sit on your hands when the market is quiet? The men who succeed in this business learn to become comfortable with stillness. They understand that capital grows during the waiting just as much as during the execution. Every avoided bad trade is money preserved, and money preserved is ammunition for the next real opportunity. When you align W1 for direction, D1 for structure, and H4 for execution, you are no longer guessing at the market's mood. You are reading its posture. There is a quiet confidence that comes from this alignment, not arrogance, not overtrading, just calm conviction. And that, more than any indicator, is what begins to change a trader's results. Most will continue to hunt on the lower time frames because it feels productive. It feels active. It feels like trading should feel. But feelings have never paid a trader consistently. The charts are always speaking. The question is whether you are finally looking at the right ones. The weekly trend sets the true market bias, and most traders ignore it to their own expense. You see, the market is like the ocean. From the shore, the waves look chaotic, restless, and unpredictable. But if you step back far enough, you begin to notice the tide. The weekly chart is that tide. It tells you where the heavy money is leaning, where the real pressure is building, and most importantly, which direction the path of least resistance favors. Now ask yourself honestly, how often have you taken a trade on a small time frame without first checking the weekly trend? Most traders rush straight to execution. They zoom in too quickly. They hunt for entries before they understand the battlefield, and then they wonder why perfectly good-looking setups fail. The weekly chart does something powerful. It removes the illusion of randomness. When you look at price through a wider lens, the market's behavior begins to make more sense. What once looked like sharp reversals on lower time frames often reveals itself as nothing more than minor pullbacks within a much larger move. That realization alone can save a trader from countless unnecessary losses. There is a simple truth in speculation. Trading against the dominant higher time frame trend is like rowing against the current. It can be done, yes, but it requires far more effort, far more precision, and far more luck. Most traders do not have the discipline or timing skill to pull that off consistently. Do you? The weekly trend reflects the footprint of institutions, funds, and large operators. The participants who actually move markets in a meaningful way. These players do not make decisions based on 5-minute fluctuations. Their positions take days, weeks, sometimes months to build and unwind. When you align yourself with the weekly bias, you are not predicting the market. You are cooperating with the larger money already at work. Many traders make the mistake of believing that more screen time equals better results. They stare at every tick, every candle, every small movement, thinking they are gaining insight. In reality, they are often drowning in detail while missing the broader narrative. The weekly chart simplifies the story. It answers the most important question first. Is the market generally being accumulated or distributed? Once that bias is clear, everything else becomes easier. Trade selection improves. Risk placement becomes more logical. Emotional pressure decreases because you are no longer fighting every small fluctuation. You begin to trade with the wind at your back instead of in your face. There is also a psychological advantage that rarely gets discussed. When you ground your decisions in the weekly trend, you naturally become more patient. You stop reacting to every small counter move because you understand the larger structure is still intact. This steadiness is what separates the seasoned operator from the nervous beginner. Think about how many times the market has shaken you out of a trade, only to continue in your original direction hours or days later. Frustrating, isn't it? More often than not, that happens because the trader was focused too narrowly. The weekly trend was still valid, but the trader allowed lower time frame noise to push them out prematurely. The weekly chart also improves your sense of location, not just direction, but position within the broader move. Are you entering near the beginning of a potential expansion, or are you chasing near exhaustion? The weekly structure often answers that question quietly but clearly, yet most traders never give it the attention it deserves. This does not mean the weekly trend is infallible. Nothing in markets is. Trends evolve, conditions shift, but the weekly time frame dramatically increases the probability that you are aligned with the dominant force rather than fighting it blindly. In trading, probability is everything. Certainty is an illusion that empties accounts. There is a discipline required here that many struggle to develop. It requires slowing down before speeding up. It requires checking the higher time frame even when you feel eager to jump into a setup. It requires the humility to admit that the market's larger direction matters more than your short-term opinion. But those who build this habit begin to notice something subtle over time. Their trades feel less stressful. Their entries feel more intentional. Their losses, when they occur, make more structural sense instead of feeling random. And quietly, without dramatic fanfare, their consistency begins to improve. Because once the weekly trend is respected, the market stops feeling like chaos and starts behaving more like a system with rhythm and flow. Most traders never stay patient long enough to truly see it. The daily chart reveals institutional footprints. And if you learn to read it properly, the market starts to feel far less mysterious. Most traders spend their time staring at the smallest candles, hunting for quick moves, quick entries, quick gratification. But the market's real story is rarely written in those tiny bursts of noise. It unfolds slowly, deliberately, and often quietly on the daily time frame. That is where the larger operators leave their marks. Think about it for a moment. Institutions cannot enter and exit positions the way retail traders do. Their orders are too large. Their size alone forces them to move carefully, often accumulating or distributing over several days. This process leaves patterns, footprints, that become visible on the daily chart long before they are obvious on lower time frames. Have you been watching closely enough to notice them? The daily time frame acts like a magnifying glass for meaningful price behavior. Not the frantic back and forth of intraday noise, but the deliberate push and pull between real supply and real demand. When buyers are truly in control, the daily candles tend to show strong closes, steady progression, and shallow pullbacks. When distribution is taking place, the chart begins to look heavy, with failed rallies and increasingly weak recoveries. Many traders make the mistake of reacting to every sharp move they see on smaller charts. But sharp does not always mean significant. The daily chart helps you distinguish between temporary excitement and genuine commitment from larger players. That distinction alone can dramatically improve decision-making. There is also the matter of structure. The daily chart provides clearer swing points, cleaner support and resistance zones, and more reliable context for where price is likely to react. Lower time frames often create the illusion of constant opportunity, but the daily time frame shows where the real decision points are forming. Do you want to trade where everyone is guessing, or where the bigger money is clearly defending levels? Another advantage of the daily chart is emotional stability. When traders operate only on fast charts, they tend to become reactive. Every small pullback feels threatening. Every spike feels urgent. But when your analysis is grounded in the daily structure, you begin to see these movements for what they usually are, normal fluctuations within a broader move. This shift in perspective changes behavior. You stop panicking at every retracement. You stop chasing every breakout. You begin to wait for price to come into areas that actually matter. And patience, in this business, is not just a virtue. It is protection for your capital. The daily chart also improves timing when used correctly with higher and lower time frames. The weekly chart may tell you the dominant direction, but the daily chart often shows when momentum is strengthening or weakening inside that larger trend. It is the middle layer, the translator between the big picture and the precise entry. But there is a trap here that many fall into. Simply looking at the daily chart is not enough. You must learn to interpret behavior, not just patterns. A level is not important because a line is drawn there. It is important because of how price reacts when it arrives. Does it reject strongly? Does it stall? Does it slice through with conviction? The daily time frame gives you the clearest view of these reactions. Over time, traders who respect the daily chart begin to notice something subtle but powerful. The market stops feeling random. Movements begin to appear more intentional. You start to anticipate areas of interest instead of constantly reacting after the fact. And when you combine that awareness with patience and disciplined risk management, the daily chart quietly becomes one of the most valuable tools a trader can keep on the screen. H4 provides precision without emotional noise, and that is a balance most traders spend years trying to find. You see, the lower time frames move fast enough to excite the nerves, but often too fast to trust. The higher time frames, on the other hand, offer clarity, but can feel slow to the impatient operator. The 4-hour chart sits in a very interesting middle ground. It slows the market down just enough to reduce the chaos, yet it still offers timely opportunities for precise execution. Most traders either zoom in too far or step back too much. Rarely do they operate comfortably in between. But the H4 time frame was built for the trader who wants structure without suffocation, movement without madness. Have you noticed how much cleaner price looks when you step up to H4 compared to the 15-minute chart? On H4, false breakouts tend to expose themselves more clearly. Weak momentum becomes easier to spot. Support and resistance begin to carry more weight. The candles themselves tell a more honest story because each one represents a meaningful block of time. Not just a burst of emotional activity from the market crowd. There is also something else that happens on the 4-hour chart, something psychological. Your decision-making slows down naturally. You are no longer tempted to jump in and out of trades every few minutes. You begin to wait for candles to close. You begin to respect confirmation. And in trading, that small shift in behavior often separates consistency from frustration. Now consider execution. The weekly chart gives direction. The daily chart reveals the battlefield. But the 4-hour chart is where the skilled operator often pulls the trigger. Why? Because it offers enough detail to fine-tune entries while still keeping you aligned with the broader flow. It is precision with perspective. Many traders complain about being stopped out repeatedly on lower time frames. More often than not, the problem is not their idea. It is their timing. The H4 time frame smooths out much of the intraday volatility that hunts tight stops. It allows you to place risk more logically, beyond meaningful structure rather than inside random noise. Does that sound like something your trading could benefit from? Another advantage is emotional endurance. When you trade very fast charts, your mind is constantly engaged, constantly reacting, constantly under pressure. Fatigue builds quickly, and tired traders make poor decisions. But the 4-hour rhythm forces you to step back. It creates natural pauses between decisions. These pauses are valuable. They give you time to think instead of simply react. The H4 chart also reveals momentum shifts earlier than the daily chart while still filtering much of the lower timeframe deception. This makes it particularly useful for managing trades. You can spot when a trend is beginning to lose strength or when a pullback is likely just temporary. It is not perfect. No timeframe is, but it offers a cleaner window into developing price behavior. But let me be clear about something. The 4-hour chart is not magic. It does not guarantee better trades simply because you switch to it. What it does is improve the environment in which your decisions are made. And in speculation, environment matters more than most realize. Traders who learn to respect H4 often develop a calmer presence in the market. They stop feeling rushed. They stop feeling hunted by every small move. Their trades begin to have breathing room. Their analysis begins to carry more context, and slowly, almost quietly, their execution improves. Because when precision is combined with patience, and noise is kept at a distance, the market becomes much easier to read. Noise decreases as time frame increases. And this is one of the quiet truths that separates the seasoned trader from the restless beginner. The market, when viewed too closely, looks chaotic. Every candle seems urgent. Every move appears meaningful. But much of what traders react to on lower time frames is nothing more than random fluctuation. The natural breathing of price as orders flow in and out. When you zoom out, that apparent chaos begins to settle into something far more orderly. Think about how a 1-minute chart behaves. Price jumps, stalls, spikes, reverses, often with no follow-through. To the inexperienced eye, it looks like constant opportunity. To the experienced operator, it often looks like expensive noise. Have you ever entered a trade on a small time frame only to watch price whip back and forth without direction? As you move up to higher time frames, something subtle but powerful happens. The small, meaningless movements begin to fade into the background. What remains are the moves that actually matter, the ones driven by real buying and selling pressure over time. The chart begins to tell a cleaner story. This is because higher time frames compress data. Each candle represents more transactions, more decisions, more participation. Random ticks that might look dramatic on a 5-minute chart become barely visible on the daily or weekly view. In other words, the market's static gets filtered out naturally. Many traders do not realize how much their stress is tied directly to the time frame they trade. Lower charts create urgency. They demand constant attention. They tempt the trader to act repeatedly, often without sufficient context. And with each unnecessary action comes friction, commissions, spreads, slippage, and most dangerously, emotional fatigue. When noise is reduced, decision-making improves. It becomes easier to identify true breakouts versus weak probes. Support and resistance zones become more reliable. Trends appear more stable. You are no longer reacting to every twitch. You are responding to meaningful movement. Ask yourself something honestly. How many of your losing trades began with what looked like a perfect setup on a very small time frame? And how often did that same setup look far less convincing when viewed from a higher chart? This is the market's little trick. It offers clarity to the patient and confusion to the hurried. The trader who insists on operating in the noisiest environment must accept the consequences that come with it. More false signals, more emotional swings, and more frequent second-guessing. Higher time frames also improve your sense of proportion. A pullback that looks terrifying on the 15-minute chart often appears completely normal on the daily. This shift in perspective is not just technical, it is psychological. It helps you hold quality positions longer and avoid being shaken out by routine volatility. But reducing noise does not mean removing all uncertainty. Markets will always contain risk. Higher time frames simply tilt the odds slightly more in favor of clarity over confusion. And in trading, even a small edge, applied consistently, can make a meaningful difference over time. There is a discipline required here that many traders resist. The slower the chart, the more patience is demanded. The fewer the signals, the more selective you must become. Some traders find this uncomfortable. They equate activity with progress. But the market does not reward business. It rewards judgment. Over time, traders who embrace higher time frames often notice a quiet change in their performance. Their trades become less frequent but more deliberate. Their charts look calmer. Their emotional swings begin to soften. Because when the noise fades, the market finally begins to speak clearly. Patience compounds trading edge over time, and most traders underestimate just how powerful that compounding really is. In the beginning, nearly everyone believes success comes from finding better indicators, faster entries, or more trades. It feels logical. More activity should mean more opportunity. But the market has a way of punishing that kind of thinking. The truth is quieter, less exciting, and far more profitable. The trader who waits well often outperforms the trader who acts often. Patience is not simply about waiting longer. It is about waiting correctly. Waiting for alignment. Waiting for structure. Waiting for price to come into areas that actually matter. When you do this consistently, your edge begins to stack on itself like interest in a well-managed account. Think about your last 10 trades. How many were taken because everything truly lined up, and how many were taken because the chart was simply moving, and you felt the urge to participate? That difference, small as it seems, is where compounding begins. Every avoided bad trade protects capital. Every protected dollar remains available for the next high-quality opportunity. Over time, this preservation becomes powerful. Many traders focus only on how much they can make, but the seasoned operator pays just as much attention to how much he avoids losing unnecessarily. There is also a psychological compounding effect. When you trade patiently, your emotional state stabilizes. Fewer impulsive entries mean fewer regret-driven exits. Fewer losses taken in frustration mean clearer thinking on the next setup. Your decision-making loop improves, trade after trade. Contrast that with the impatient trader. Constant entries create constant exposure. Constant exposure creates constant emotional pressure. And under pressure, even a good strategy begins to leak performance. Have you noticed how your worst mistakes tend to come after a streak of overtrading? Patience also improves trade quality in a very mechanical way. The more selective you become, the more your average setup quality rises. Your risk to reward improves naturally because you are no longer forcing trades in mediocre locations. You begin operating only where the chart gives you a clear advantage. This is where the real compounding takes place, not just in account balance, but in decision quality. Small improvements in entry quality, risk placement, and emotional control begin to stack over months and years. The growth is rarely dramatic at first. In fact, it often feels slow, but steady processes in trading tend to outperform explosive bursts followed by deep drawdowns. There is a common discomfort that appears when traders first attempt to become more patient. The market keeps moving, and they feel like they are missing out. That feeling is natural, but it is also expensive if acted upon. The professional understands that missed trades cost nothing. Poor trades cost capital and confidence. Another overlooked benefit is clarity during drawdowns. Patient traders usually experience smoother equity curves because they are exposed to fewer low-quality setups. Losses still occur. They always will. But they tend to be more controlled, more understandable, and easier to recover from. Ask yourself this. Would you rather take 10 average trades hoping a few work out, or 3 high-quality trades where the odds are clearly in your favor? Most beginners choose the first path without realizing it. Professionals quietly choose the second. Over time, patience stops feeling like inaction and starts feeling like control. You begin to trust the process more. You stop feeling the need to chase every movement. The market slows down, not because it actually does, but because your decision-making becomes more deliberate. And when patience and edge begin working together consistently, the results tend to build in ways that surprise those who are still rushing. Fewer trades often mean higher quality trades. And this is a lesson most traders learn the hard way. In the beginning, activity feels productive. The screen is moving, candles are printing, setups seem to appear everywhere. It creates the illusion that the more you trade, the faster you improve. But the market does not reward effort the way most professions do. In trading, more action often leads to more mistakes. Every trade you take carries friction, spread, commission, slippage, and most importantly, psychological exposure. When you trade too frequently, these small costs begin to stack quietly against you. Many traders focus only on their win rate, but they rarely calculate the hidden price of unnecessary participation. Have you ever looked back and realized half your trades were simply not needed? When you become selective, something important happens. Your standards rise. You stop entertaining mediocre setups. You begin asking harder questions before committing capital. Is the higher time frame aligned? Is the level meaningful? Is the risk placement logical? This filtering process naturally improves trade quality. The impatient trader often believes more trades equal more opportunity. The experienced operator understands the opposite is often true. The market only offers a handful of truly favorable conditions at any given time. The rest is noise dressed up as movement. There is also the matter of focus. When you take fewer trades, each position receives proper attention. You manage risk more carefully. You monitor structure more calmly. Your decisions become more deliberate instead of reactive. Overtrading, on the other hand, scatters attention and increases the likelihood of emotional mistakes. Think about your most frustrating trading days. Were they the days you took one well-planned trade, or the days you jumped in and out repeatedly? trying to force results. Most traders already know the answer, even if they have not fully accepted the lesson. Another advantage of fewer trades is emotional preservation. Every position you open creates mental exposure. Win or lose, your nervous system reacts. When this happens too frequently, fatigue builds, decision quality drops, discipline weakens. The trader may not notice it immediately, but performance often begins to deteriorate quietly. Fewer trades help maintain psychological sharpness. You remain patient. You remain objective. You avoid the spiral of revenge trading that often follows a string of impulsive entries. This stability is not glamorous, but it is extremely valuable over long periods. There is also a structural benefit. High-quality trades tend to originate from clear locations, strong support and resistance, well-defined trends, or meaningful higher time-frame zones. These situations do not appear every hour. They develop slowly. The trader who is willing to wait naturally positions himself where the probabilities are stronger.